This is capital collapse. The gold to silver ratio just hit 51 to 1. That means it takes 51 ounces of silver to buy a single ounce of gold. And here's why this number should have your full attention. This ratio doesn't stay stretched for long. And when it snaps back, silver doesn't just outperform gold. It absolutely explodes. Let me show you exactly what happens every single time this ratio gets extreme, because we've seen this movie before. And the ending is always the same. Violent, fast, and incredibly profitable if you're positioned correctly. If you're new to Capital Collapse, hit that subscribe button. I break down market data that actually matters, not the noise. And comment below with whether you're holding gold, silver, both, or neither. I want to know where you're positioned right now. Let's start with what this ratio actually means. Gold is currently trading around $4,900 per ounce. Silver is trading around $96 per ounce. Divide 4,900 by 96 and you get 51. That's the gold to silver ratio. It tells you how many ounces of silver equal 1 ounce of gold in terms of price. Now here's where it gets interesting. If you go back through history, this ratio moves a lot. In 1980, when silver hit $50 and gold was around $850, the ratio was 17 to 1. In 2011, when silver hit $50 again and gold was at $1,900, the ratio was 38 to 1. In 2020, at the peak of the COVID panic, the ratio exploded to 125 to 1. Gold was $1,700, silver was $12. And here's what happened after that 2020 extreme. Within 6 months, the ratio collapsed from 125 to 70. How? Silver rallied 150% from $12 to $30. Gold rallied 18% from $1,700 to $2,000. Silver massively outperformed. If you bought silver at that 125 ratio peak, you made 8 times more than gold buyers over the same period. That's not a one-time event, that's the pattern. When the ratio gets extreme, it corrects violently. And silver is always the one that moves faster because it's a smaller market with more volatility. Now let's talk about why 51 to 1 is significant. The historical average over the last 100 years is around 60 to 70. So at first glance, 51 doesn't look crazy. It's actually slightly below the long-term average. But here's what changes everything. The geological reality. The Earth doesn't care about price ratios. The Earth produces metals at a fixed rate, and that rate is 8 to 1. For every single ounce of gold that gets mined out of the ground, miners extract 8 ounces of silver. Let me repeat that. The mining ratio is 8 to 1. The price ratio is 51 to 1. Gold is trading at 6 times the multiple of silver compared to how much actually gets produced. Does that make sense? If both metals are being pulled from the earth at an 8 to 1 rate, why is the price 51 to 1? Now let's look at storage. The COMEX vaults, where futures contracts are backed by physical metal, hold 12 ounces of silver for every ounce of gold. The LBMA vaults in London hold 3 ounces of silver for every ounce of gold. So we're mining silver at 8 times the rate of gold. We're storing it at 3 to 12 times the rate. And it's priced at 51 times less. Here's what that tells you. Either silver is massively undervalued relative to gold, or gold is massively overvalued relative to silver. One of these metals is mispriced. And given that industrial demand for silver is exploding while gold sits in vaults doing nothing, I'll let you guess which one is more likely to correct. Now let me show you the historical pattern, because this is where it gets really important. Every time the gold to silver ratio has gotten stretched above 80, it has corrected violently. And I mean violently, not slow, not gradual, fast and explosive. 1991, the ratio hit 100. Over the next 7 years, it collapsed to 40. Silver outperformed gold by 150%. 2003, the ratio hit 80. Over the next 8 years, it collapsed to 32. Silver rallied from $4 to $50, while gold went from $320 to $900. Silver gained 1,150%. Gold gained 490%. Silver more than doubled gold's performance. 2008 financial crisis, the ratio spiked to 84. Within 3 years, it dropped to 32. Silver went from $9 to $50. That's a 455% gain. Gold went from $720 to $900. That's a 164% gain. Silver crushed gold again. 2020 COVID crash, the ratio exploded to 125. That was the most extreme level in modern history. And what happened? Within 6 months, it collapsed to 70. Silver rallied 150%. Gold rallied 18%. Silver outperformed by a factor of 8. Do you see the pattern? Every single time the ratio gets extreme, it corrects. And every single time, silver is the one that moves faster and harder. Why? Because the silver market is smaller. It takes less capital to move the price. When money flows into precious metals, gold gets the first wave, but silver gets the leverage. Now here's where we are today. The ratio is at 51. That's not as extreme as 125 or 100 or 84. But here's what makes this moment different. Industrial demand for silver has never been higher. Solar panels, electric vehicles, electronics, 5G infrastructure, all of these require silver. And production hasn't increased. We're mining roughly the same amount of silver today as we were 10 years ago, but demand has doubled. Gold doesn't have that. Gold is a store of value. It sits in vaults. Central banks buy it. Investors hold it. But it doesn't get consumed. Silver does. Every solar panel installed permanently removes silver from the market. It doesn't get recycled efficiently. It's gone. That creates a structural deficit that gold doesn't have. So when you combine the mining ratio of 8 to 1, the storage ratios of 3 to 12 to 1, the industrial demand surge, and the historical pattern of violent corrections, what do you get? You get a setup where silver is coiled like a spring. Now let me show you the math. If the ratio corrects from 51 to just 40, which would still heavily favor gold compared to mining fundamentals, here's what happens. If gold stays at $4,900, silver needs to rise to 122s. That's a 27% gain in silver versus 0% in gold just from the ratio normalizing. If the ratio corrects to 30, which is where it went in 2011, silver needs to hit $163 while gold stays flat. That's a 70% gain. And if gold also rises during this period, which it typically does when precious metals are in a bull market, silver goes much higher. If gold hits $6,000 and the ratio compresses to 30, silver is at $200. But here's the part that most people miss. The ratio doesn't correct slowly, it snaps. When silver starts moving, it moves fast. In 2020, it went from $12 to $30 in less than 6 months. In 2010 to 2011, it went from $18 to $50 in 10 months. These aren't slow grinds. These are explosive moves that happen quickly and leave most people behind because they're waiting for confirmation. Now let me address the other side because you need to understand the risks. The ratio can stay stretched longer than you think. It can even get more stretched before it corrects. In 2020, before the ratio collapsed from 125, it first spiked from 80 to 125 in a matter of weeks. If you bought silver at 80, thinking that was extreme, you watched it get worse before it got better. So timing this is not easy. The ratio can be a leading indicator, but it's not a timing mechanism. You can see that silver is undervalued relative to gold at a 51 ratio, but that doesn't tell you when the correction happens. It could be next month, it could be next year. Markets can stay irrational longer than you can stay solvent if you're using leverage. And that's the key point. If you're trading this with leverage, if you're trying to time the exact bottom, this ratio can destroy you. But if you're building a position over time, if you understand that silver is structurally undervalued relative to gold at this ratio, and if you can handle volatility, then this setup is one of the best risk-reward opportunities in the market right now. Here's why. The downside is somewhat limited. Silver is already at $96. It crashed from $121. If it falls another 20%, you're at $76. That's painful, but survivable. But the upside, if the ratio compresses to historical norms, you're looking at 50% to 100% gains. And if we get a real precious metals bull market where both gold and silver rally together, you're looking at 200% to 300% gains in silver. That's asymmetric. Downside of 20%, upside of 100% to 300%. Those are the kinds of setups that smart money looks for. Not guaranteed, not risk-free, but mathematically favorable over time. Now let me show you what the smart money is actually doing. You can track this through the CFTC's Commitment of Traders report. It shows you who's long and who's short in the futures markets. And here's what the data shows. Large speculators, which include hedge funds, are currently net long silver. Commercial traders, which are the banks and big institutions, are net short. That positioning has been consistent for months. Speculators are betting on higher silver prices. Commercials are betting on lower prices. Who wins? Historically, when speculators get too long and commercials are heavily short, that's a warning sign. Speculators often get liquidated before the big move happens. We just saw that with the 22% crash. But here's the twist. After speculators get shaken out, after the weak hands get liquidated, after the ratio stretches even further, that's when the real move begins. The commercials cover their shorts, speculators who survived come back in, and the ratio snaps back violently. We've seen this pattern repeat over and over. So where are we in the cycle right now? We just had the shakeout. Speculators got liquidated, silver crashed 22%, weak hands are gone. The ratio is at 51, which is stretched relative to geological fundamentals, but not extreme relative to recent history. And physical demand is surging, evidenced by the record Shanghai premiums we talked about in the last video. To me, that looks like we're setting up for the next leg higher. Not today, not tomorrow, but over the next 6 to 12 months, I would not be surprised if this ratio compresses significantly. And when it does, silver will be the one that moves. Let me give you 3 scenarios. Scenario 1, gold stays flat at $4,900 and the ratio compresses to 40. Silver hits $122. That's a 27% gain in silver, 0% in gold. Scenario 2, gold rallies to $5,500 and the ratio compresses to 35. Silver hits $157. That's a 63% gain in silver, 12% in gold. Silver outperforms by 5x. Scenario 3, gold rallies to $6,000 and the ratio compresses to 30. Silver hits $200, that's a 108% gain in silver, 22% in gold. Silver outperforms by 5x again. In every single scenario where the ratio normalizes, silver massively outperforms gold. The question isn't if. The question is when. Now, let me be very clear about something. I'm not telling you to buy or sell anything. I'm not giving financial advice. I'm showing you the data. The mining ratio is 8 to 1. The price ratio is 51 to 1. Historically, when these diverge, they eventually converge. And when they converge, silver moves faster than gold. That's not a prediction. That's historical fact. What you do with that information is entirely up to you. If you're someone who can handle volatility, if you understand the difference between short-term price action and long-term fundamentals, if you're building a position for the next 1 to 3 years, then this ratio is telling you something very clear. Silver is undervalued relative to gold. But if you're trading on margin, if you need this to work out in the next 3 months, if you can't handle watching your position go down 20% before it goes up 100%, then this trade is not for you. The ratio is a long-term indicator. It's not a short-term timing tool. So here's what I'm watching. I'm watching the ratio. If it breaks below 50 and heads toward 45, that's the beginning of the compression. That's silver starting to outperform. If it breaks above 55 and heads toward 60, that's more pain for silver in the short term. But even at 60, the setup is still there. It just takes longer to play out. I'm also watching the COT data. If commercial shorts start covering aggressively, that's a bullish signal. If speculative longs start building again after the shakeout, that's confirmation that the next leg is starting. And I'm watching physical premiums. As long as Shanghai is paying $40 over COMEX, as long as dealers can't source metal at paper prices, the physical market is telling you that paper price is wrong. 3 things to take away from this video. Number 1, the gold to silver ratio is currently 51 to 1, while the mining ratio is 8 to 1. That's a 6x divergence from geological reality. History shows these divergences don't last. They correct violently. Number 2, every time the ratio has gotten stretched above 80, it has corrected back to 30 to 40 within a few years. And every single time, silver has massively outperformed gold during the correction. This pattern has repeated for decades. There's no reason to think this time is different. Number 3, the setup right now is asymmetric. Silver's downside is somewhat limited after the 22% crash. But if the ratio normalizes, the upside is 50% to 200%, depending on where gold goes. That's the kind of risk-reward that smart money looks for. Not guaranteed, but mathematically favorable. Now I want to hear from you. Are you holding more gold or more silver right now? Do you think the ratio compresses from here or stretches further? Drop your take in the comments. And if you're split between the two, tell me your allocation. I want to see how this community is positioned. If you found this breakdown valuable, share it with one person who's trying to figure out the gold versus silver question. This ratio analysis is something most people never learn, and it's one of the most powerful tools for understanding precious metals. Subscribe to Capital Collapse for more market analysis like this. I track the data that actually matters, not the headlines, and when the ratio starts moving, you'll want to be in the loop. This is Capital Collapse. The ratio is 51 to 1. The geology says 8 to 1. One of these numbers has to give. I know which way I'm betting. Do you?